This is The Way I See It with Steve Reitmeister.
Normally I'm getting at long-term investing has greatly changed. Well, I should. I'm putting my money where my mouth is.
Each week, Steve shares his unique perspective with us on a wide variety of investment and financial topics. He tries to help investors chart the best course toward profits no matter what the market has to offer. This week is no exception, and today you seem to be turning your attention to the important role that the professional investors, the quote-unquote professional investors, play in the stock market, and how the individual investors out there may be able to beat them at their own game. Now, I think the first order of business is to define for us, if you would, professional investor.
Right. A lot of people use the term institutional investors and professional investors interchangeably, and what we're talking about are the folks who invest other people's money as a living. Hedge fund managers, mutual fund managers, pension plan managers, and the like. And so they're the folks who are really the 800-pound gorillas of the investment world, because they come to market with trillions of dollars of other people's money to invest in the marketplace.
Quite often we hear about professional investors rarely outperforming the market.
Very true.
And so if that's the case and they are not as effective, I don't necessarily want to say they're so ineffective, but if they're not as effective as they could be, then should individual investors even care about them?
Right, and most of us have heard about the studies that 85% of mutual funds underperform the market year after year, which is kind of an embarrassing blemish on professional investors. But if we pull back from there and we say, okay, the stock investing game, and I hate to you use the word game because it trivializes what this is, because we are talking about our nest eggs and our money, but for this conversation, let's just say that stock investing is a game, and like any other game, you need to know the strategies of how to win. In this game, the big players, as we're saying, are the institutional investors, are these professionals who are coming with so much money to bear. And they have the greatest opportunity to push stocks in either direction. You know, when they're buying it up, they're going to race up, and opposite on the way down. So it's important for us in this investing game to understand the motivations of the big players and how it is they make their buy, sell, and hold decisions. And in understanding the way that they come to market, we can gain an advantage over them.
All right. What are the main decision-making factors, then, that institutional investors kind of consider when buying and selling stocks?
Right. What you have to consider is, now I'm not trying to lump them all together and say they're all a homogenous group of individuals, but there are some commonalities between professional investors that we can point to, which you can understand why they make the decisions they do.
Okay.
Most of these folks go to prestigious business schools, a lot of the Ivy League institutions, for which there they learn a lot of the classical fundamental models of how to invest in the stock market and how to value stocks. Then when they graduate and they go to a lot of the different investment houses and money management firms, they usually have to start as an analyst, meaning they have a industry that they cover, they understand the basics of how to value these companies. They usually will go for what's called a CFA designation, which is Chartered Financial Analyst. I'll simplify what a CFA is by saying they're an accountant on steroids. Okay, their understanding of financial models is just exemplary, and that's why they're paid so highly. So most people become analysts, and then from being analysts, they might become money managers in time. So in this whole process, most of them classically trained, understand fundamental models of how to value stocks. And that's where we're going to come up with our first slide here, which is that, you know, there's a classic model called the dividend discount model, which there's been so many permutations of that model over time. But if we simplify it, we say that the current value of a stock is the present value of its future stream of earnings. Okay, and which is a fancy way of saying if you were to buy a company outright, the entire thing, what would that company be worth to you? Well, how much profit am I going to make in the future, and what am I willing to pay for that profit today? And so that's the basic valuation models that most of these guys work off of.
All right. So with a focus on the future stream of earnings, what you really mean is that this is just another group of investors who rely upon earnings estimates.
Right. We're getting back to the basics of what this firm is about, and absolutely true. So future stream of earnings is a fancy way of saying that they're taking a look at earnings estimates for companies in the future. And so here again, you have a simple mathematical model, which is an input and output. And on the input side is earnings estimates, and the output is what is the fair value for that stock today. And so if we take this decision-making process, and we'll take a look at the next slide here, is that if earnings estimates are going up for a firm, then the natural outcome is the fair value of the stock is perceived to be higher. If that is the case, then the institutional investors will put more money into those stocks, which then chases up the stock price. If we take a look at it in reverse, and on the next slide, we'll see that the opposite chain of events happens. When earnings estimates for a company are going lower, meaning their future prospects are not as bright as we thought they were in the past, the next logical step in that is that the fair value of that stock is going to be lower than it is today, and people will start selling off that stock, which leads to a lower share price. This is the basic model in which most classically trained investors will bring to the market, and certainly institutional investors with their big money, this is what moves the market.
So then if these institutional investors are in fact reacting to earnings estimates and are throwing a lot of money around, then what is the investment opportunity exactly that's available to the individual?
Right. We have a great advantage in that we can move so much faster than the institutional investors. And Len Zacks said it best in a piece he did for the Zacks Method for Trading. He talked about the molasses slow nature of the decision-making process that institutional investors go through. If you were to think about it, so let's say like a large mutual fund, there's going to be a team of 5, 10 analysts, and sometimes just one money manager. Sometimes it's a committee of money managers, which is even worse. Anytime you have a committee, it's going to slow down the process. So they're evaluating stocks, 60 hours a day, and just nonstop. They have to sit down and sometimes say, okay, what stocks is it that we want to buy and what stocks do we want to sell? So they get together in meetings, so the analysts and the money managers, they get together in meetings, and they're not going to meet every 12 seconds, they're going to meet like once or twice a week. So here again, everything is slowing down the process. So now let's say they do find a stock they want to buy. And to have a substantial position in it, a large mutual fund would want to take like a $50 million position in it. They can't just go into their E-Trade account and buy $50 million of that share, because with the supply and demand dynamics, the way stock prices work, they would be chasing up that stock price so fast, they would be doing damage to their own position. So it's what they call in the mutual fund business accumulation. They're going to start adding up the position over a 2 to 4 week period, just slowly working their way in there as not to chase up the stock price themselves. Same thing's going to happen in reverse. If they know that they want to get out of a stock, if they try and sell $50 million worth of a stock, even if that's IBM, which has a big float out there, they're going to be affecting the stock price. So here again, the distribution of when they're selling a stock price is also going to take over a 2 to 4 week time period. You and I, we can go into our E-Trade and Ameritrade accounts, and within 1 minute, okay, and I know we like to think we're big players here, but even you and I cannot move.
I am. It's just
you and I cannot move the market the way the institutions can. So we have this great advantage in time that we can take care in 1 minute with that takes them 4 weeks.
All right. Well, that is the way Steve sees it on beating the pros, as it were, at their own game. His opinions are his own, not necessarily those of Zacks Investment Research or any of its subsidiaries or affiliates. With Steve Reitmeister, our editor-at-large, I'm Terry Ruffalo.